a single coronavirus case that they discovered with a 58-year-old man suspected to have caught the Delta variant. Only groceries and other essential businesses will stay open. Now, overnight, the Shanghai Composite having another rough go, down 2% after falling roughly that amount on Monday. I'd like to point out that GXC, the Spider China ETF, is now down 14% since July 1st, wiped out all its gains since the start of Q4 2020. And finally, just a few more names here. Toyota Motor, maybe keep an eye on that stock. TM, nearest 50-day moving average, is built a flat base on top of a longer base. Stellantis, which we highlighted last week, STLA, that's near a cup without handle entry point 21.49. Enphase Energy, EMPH, they exited leaderboard after they fell below an aggressive trendline entry, and AutoNation AN joined Swing Trader on Monday. Keep an eye on how that stock is doing, and we'll send it back to you, Allie.
All right, thank you so much for that. Now we turn our attention to Thinkorswim from TD Ameritrade. So I'm going to go ahead and pull up my chart here. Give me 1 second. I lost my Zoom control, but it'll get back any second. Here we go. So Justin, give us your thoughts on the action that we saw yesterday for the NASDAQ. It was a pretty impressive reversal here, finding support at the 21-day line. So give us your thoughts on what we saw in the market yesterday.
Well, we were joking yesterday morning about how, we needed a little bit more of a shakeout, and whether Chris needed to get shaken out, and that it felt a little bit more dramatic yesterday. But the question is, was it enough? Because there really has been a lot of resilience here in the NASDAQ, and the S&P 500 and the Dow Jones Industrial Average, those were pushing to all-time highs yesterday, and they really, their pullback intraday was really only to like the 10-day moving average line. So I think that question still remains out there. Was it enough of a pullback, to kind of clear the decks? And right now, I don't think it was. That doesn't mean we can't go up from here. That's what the market's been doing. It's been shaking off stuff, going to new highs. So it's just a matter of checking to see if what happens here. So I think it requires some flexibility, but it also doesn't seem to me like it's a time to be overly aggressive right now.
Right. And David, give us your thoughts on how you were handling your portfolio yesterday in light of the action that we saw. How are you handling your portfolio this week?
Well, I continue to be way under 50% invested. I think there's a mask going on. The market has a mask. The S&P and the triple Qs, yes, they're holding up, but internally in the market, I've seen there is a very, very weak advanced decline, especially on the New York Stock Exchange. The NASDAQ 100, that seems to be okay, but it's something that you have to be very, very careful of what's going on internally in the market. And just by looking at what my equity has done in the last 2 months or so, it's just chop. Yeah. I get a few good stocks and great move out of an AMD or Perkin-Elmer, but then I get hit on a number of other stocks. So that's why I have a lot of cash, and I'm going very, very slow, and I'm being very careful. I've seen too many markets top in August over the years, and they have a decline into October. So that's another thing I keep in mind. The other thing is that I saw a statistic yesterday, is that it's been 187 trading days since we've had a 5% drop in the market. Yeah. The average since 1929 is, I think it's something like 92. So we're overdue for a correction, but I think that correction is happening internally. And don't be fooled by the indexes of what's going on there, because I think those are staying up because of a lot of weighting in a lot of very, very high and market capped stocks in the NASDAQ.
The $1 trillion club. basically.
Yeah. But underneath, it's hard to make progress. Or I call it, I mean, the strategy is, it's sort of, I call it the bell bar strategy. Either you go super short term where you get a 3-day move or a 4-day move and you take it, or you hold for months and months, and because you're going to have a move up and then it's going to come back down, and if it's a good stock, eventually it seems to make some progress. But you go kind of intermediate term, lots of times you're giving up that move. Have a great move for a couple of weeks and then it gives it all back. So that's why I'm holding a lot of cash. It's just hard to make a lot of progress in this market.
Because go ahead, Justin.
I was just going to say, there have been a lot of times where I've made this analogy to 2017, where again, in 2017, you look at the index, and the index was just on fire on the NASDAQ, and the S&P 500, everything was just going up, it seemed like. And that was another case in which the biggest correction, I think, in the S&P 500 in 2017 was like 3.4%. It just never really pulled back, but there was this rotation underneath the surface, and this was kind of our early phase of swing trader. And Chris and I were struggling a little bit because it's exactly as you said, David. If you went super short term, you would be okay. Or if you like leaderboard, just held through stuff, you would be okay. But if you did it in between, as Mr. Miyagi said, squish like grape. It was just really, really tough to make progress. So it does remind me a lot of that. And Allie, one thing you might do is, since he mentioned the advanced decline line, for people that are wanting to see that on the MarketSmith, if you go to GMIAB, that will show an
IAD?
GMIAB as in boy.
Okay, it's the periodicity. So it has to be on a daily. Yeah. Okay, that's why I thought.
So do that on the daily.
Yeah.
That's your NASDAQ advanced decline line, which again, as David pointed out, I mean, real serious downtrend. And if you do GMIAA, that will give you the NYSE.
So flattening.
Mm-hmm.
Yeah, so you got indexes going up, but it's sort of like the generals are out there leading, but the troops are running the other way, and so it's hard because I'm not buying the indexes, and maybe I should, because they've had they seem so strong, but internally and underneath those indexes, you've got a lot of stocks just not participating. And you can see that, especially if you look at the IWMs or the Russell index. That's just, I mean, look at that relative strength line. Look at that. And look how it's still above the 200-day moving average, but that looks a little suspect. I mean, that looks like it's starting to roll over. One other index I would take a look at, and I think this has importance, is there's a China index, CQQQ, that you should bring up. And China is, look at that downtrend this is in, and look how that's rolling over. If China is a huge influence in in the world economy, look what's going on there. Is that going to affect us or affect other countries? So there's a lot of little cracks I'm seeing that you got to be careful. And that's why I've got so much cash, is because I don't see, it's not like, it was last year or even early this year.
So setting that scene, investors who are more invested in the market, what would be your advice to them for them to grade their stocks and only hold the ones that are their best performers? How do they reduce their exposure at this time?
I would go through and look at your portfolio. The first thing I would do when, like yesterday, when the market started coming off, I looked at my stocks and I saw, okay, which ones don't I have a profit in? And those are the first ones I usually kick out, because if I don't have a profit in them, there must be something wrong, my timing or that stock. And so I usually start cutting out the ones that I have losses. I actually